Welcome back, everyone. Today's video is going to be me discussing the three major, three most impactful themes that are in my portfolio and large parts of my portfolio. So just to give you a brief kind of explanation of how this came to be and how I think about my portfolio. In this video, or in a prior video, I should say, I spoke about how I like concentration on what I think obviously are good ideas. Who knows if they're actually good ideas? But when I see a scenario or a setup or a way to play something that is a very good risk reward setup, in again, that I believe is, and where I like the leverage profile, because if you look at the market, you see all sorts of different scenarios where you can get different, where you could play the same type of theme, but in different ways. So in some ways you'd have low leverage to either it could be the price of some commodity changing, or some company that just earns X every year, whether economy is good or bad, whereas some companies can earn a lot when things are going well and a lot less when things aren't going well. All of it is different forms of leverage. And then you have leverage on the company levels. But the point is, the way to play the leverage profile is a whole big part of the game in the market. How much risk you want to take, when, and how you express it. Point being, when I see a leverage profile that I like and risk reward that I like, it can become a major idea, but I could have it expressed in a number of different ways. So this video is just explaining the three biggest themes in my portfolio today. So the first theme, and this should be a surprise to approximately no one who follows this channel, is uranium. Now, uranium, originally I liked it because, well, for a number of reasons, in addition to supply and demand and all that stuff. But one interesting aspect about it was that in the short term, it's fairly uncorrelated to economic strength or economic weakness. Now, when I entered, I thought that was a positive. Now, I'm not so sure it's a positive. I don't know if it's a negative, but the point is, in the short term, you can kind of know, give or take, what the demand situation for uranium is going to be for the next 4 or 5 years, in most times at least. Now, the interesting part is in the longer term, there is actually some correlation because it depends on what other energy prices are to uh, to know, how many reactors are going to be financed and built over the long term. Um, how much competition is there going to be from natural gas and other energy sources? That's all a long-term matter, but in the near term, if you have a reactor, you're probably going to more or less need fuel for it. So that's approximately how much you're going to use in the short term. Another thing that I like, well, still do, is that it is inflation hedged. So commodities in general, mostly, are inflation hedged. So if there is a bout of inflation, either due to, well, one of any number of reasons, but not the least of which some type of MMT-like money creation, commodities usually benefit from that. So mainly, you know, anything with either sunk costs or whatever, essential things often can ride the inflation wave. So that's where the uranium comes in. Now, it's not the only thing, but another big theme in my portfolio is gold and precious metals, I should say. Although most of my exposure is to gold directly, some other times there's byproduct, other things, but mostly gold. Now, when I entered gold, it was slightly more out of favor than it is right now. I remember a time when gold mines were not gold mines. They were shareholder earnings day fear machines. It was a different time, I guess you could say. Now, that being said, I have recently, and I did a video on this, I have significantly de-risked my gold exposure. I've sold a small portion to get off some of the money that that was on the table. Now, it is still a significant position, and as you can see here, one of my three largest significant positions. Now it's less out of favor. One could even call it in favor, as I would, but I still think it probably has further to go. And the other part that I liked about gold is that math. Well, just math, really. If you looked at what was happening even a few years ago with money, with interest rates, with whatever, it seemed very evident to me that something like infinite money printing, although not infinite, but infinite, well, a lot of money was going to need to be created at a time when you need to not be paying interest on the money being created, which means that you'd have to compress the real interest rate, which is positive for gold. And who knows, eventually they'd have to inflate away some of the value of this. Again, good for gold. And you know, if on the other hand, there's always the insurance for gold in that when I look at it, when I look at the insurance factor, I'm like, okay, printing tons of money, how could this go very wrong? And again, gold kind of is a hedge for that line of thought because you consider that if anything, if things start going wrong, the answer has been print more money. Well, if that breaks in a very bad way, probably could be positive for gold. And the last one may come as a shock to some. Well, no, shouldn't, because I've discussed it in bits and pieces in recent and a few months ago videos. This is a more recent entry in terms of being a major theme, and that is an industrial recovery, because I don't think that we're going to actually be in a low growth forever and the perma-bust type of depression long-term environment. I think that eventually we will recover. And recently, there's been a very attractive long-term entry opportunity, I feel, given in the industrial sector as a whole. Now, what does this include for me in the industrial sector? Well, I mean, primarily steel. Now, steel is, you think the center of the industrial world, but really, and this comes along with how to play the themes. Really, there's plenty of ways that you can even play steel. In fact, I'm in steel as steel, but I'm also in steel as met coal, and the primary usage of zinc, well, also in steel. And so that's just part of what I mean when it comes to concentrated diversification in terms of you can play a theme in many different ways. And there's plenty of other metals that are used in the industrial world also. If you're thinking, okay, well, we're going to produce X number of electric vehicles, they're going to, grow and take the market, and they'll go to the peak auto sales. And I remember peak auto. That was a while ago. Anyway, if we're going to be producing cars like crazy and all people are going to be buying these cars, well, you're going to need an industrial recovery here for that type of thing to happen. So, even battery metals to a degree can be part of this idea of industrial recovery. Now, I would qualify it differently, but I'm just saying there is a whole lot in the markets that are interconnected. And the other thing that I would qualify as industrial recovery is auto parts. Now, parts and manufacturing, and I have it's one of my bigger positions in Linamar, which I've spoken about in the past. Anyway, that's in auto parts and manufacturing. So I would consider that whole line of thought, whether it's steel, whether it's met, whether it's zinc, whether it's auto parts, all of that is the same theme, just expressed in different ideas. Now, completely coincidentally, or maybe not, a lot of these ideas, and if you think about, if you go through one by one the things I said, I am also overexposed in the following areas. So there's overlap in other ways, in that I am overexposed to things that can benefit from inflation. That's just, again, another consideration. I'm also overexposed to energy, in that A, uranium is a form of energy, but B, well, the recovery also can overlap with energy. So, if things kind of languish for a long time, then energy probably won't do great, versus if everything's booming, energy will do significantly better. Overexposed to natural resources, oh yeah, but that also leads into my next point. I'm overexposed to things that are essential, because there's a lot of things that don't really get the juicy valuations or the SaaS premiums, but we need them. We just do. And the last thing that I'm overexposed to, and this is fun or very not sometimes, and that is risk, beta, and volatility. So my portfolio moves around a lot. It does, up and down, and I have some sharp days. And there's a lot of, as I said before, there's a lot of correlation in the market. So there's some good days and some not good days. I'll tell you that. But that's how it works. Now, as I wind this down, I just want to comment, this is not my entire portfolio. These three themes are substantial, and they represent a very substantial part of my portfolio, but there are other themes in my portfolio. Now, to name a few, agriculture. Agriculture is a decent theme in the portfolio. There's, again, some overlap, but some not. Shipping. Shipping is a piece of the portfolio. Again, it's kind of overlap, kind of partially energy, kind of partially industrial. If you look at when shipping was booming, well, steel was booming to heck all around the same time. So, there's a lot of correlation there with growth story all over the world. Now, that being said, there's a lot of vessels coming offline from the time when steel was booming, or sorry, shipping. Confusion there. And yeah, so we'll see how it goes this time. Hopefully, there's some type of global recovery and maybe booming, but that's probably a bit to ask. But we'll see. Anyway, the point is expectations have come way down for everything. Next, dividends. Now, I'm not sure you can call this a theme, but for me, instead of having a allocation for the low risk section for bonds, because I don't think I don't think very highly of bonds. Let's leave it at that. I've said in the past that what I don't think great things are in the future for bondholders, but for me, I just have that allocation in dividend things, and my goal when I buy a dividend thing is to, or most of the time, is to have that money locked off in a separate allocation where I don't touch it, because sometimes I feel like I want to dip into that, sell some dividend things, invest in something that's going to get me a higher return. But I try to have the discipline to, once I'm getting a certain income in dividends, to rule in my head is try not to give it back. And that's when I make money, try not to then go and turn and lose the money. So when I have a dividend segment, that's for, that income stream, to build up that income stream. So that's how I think about that. And also home building, primarily expressed in, as I spoke about before, West Fraser. There's a lot to be said about timber, but we'll see how it reacts in a few days when the contracts roll. So the high-priced timber contract will roll off. I think that from where the timber stocks are now, there's, it's still quite interesting in terms of they probably wiped off a good portion of the debt. and the market is moving back towards balance. We'll have to see what happens with regards to the high prices, but right now it's significantly delevered from where it was a few months ago. But so I mean the upside and downside are diminished in terms of coming in from here as an entry point. But you know, if the prices are real across the curve, then the stocks are still very cheap. But again, you know, the prices indicate that they will be lower eventually. But maybe this is a topic for its own video. Anyway, I'm still in that position. Anyway, that's all for today. Thanks for watching, everyone. I just felt like giving a brief semi-outline of how my portfolio kind of looks and what are the big things that I like in the market today. And if you enjoyed that, great. If you didn't, sorry, maybe you'll enjoy the next thing better. And until then, I hope you have a great day and catch you next time.